Welcome to the Smarter Trading Podcast. If you want to sharpen your trading skills or become a more savvy investor, then you're in the right place. Every week, we sit down with professional traders who are ready to share practical insights on what it takes to succeed in modern-day markets. Smarter Trading, the show to watch to trade smarter.
Evan Medeiros is the founder and CEO of The Trade Risk. All opinions expressed by guests are solely their own opinions and do not reflect the opinion of Evan or The Trade Risk. This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Evan and guests may maintain positions in securities discussed in this podcast.
Hey everyone, it's Evan here. We ran into some technical difficulties with this recording, and that big old microphone you see in front of my face, if you're watching this on YouTube, wasn't actually the mic that was recording. My audio is from a backup device, and so there's a bit of an echo, and it does sound like I'm in a tin can recording this, so I apologize. We tried to clean it up as much we could. Luckily, after the intro, I do very little talking in this episode, and our guest Felix's audio is great, so please enjoy this episode, and we'll be back on track with crisp, clear audio for next week. Welcome back, everyone, to another episode of Smarter Trading. I'm your host, Evan Medeiros, and today I am joined by Felix Bertram. Felix is the owner of TuringTrader.com and the designer of the site's model portfolios. Felix's background combines a strong technical foundation and a master's degree in electrical engineering with business experience from multiple innovative startups and an MBA. Felix approaches the market or investing is purely technical with a strong focus on diversification and risk management. Felix, welcome to the show.
Thanks, Evan. I'm glad to be here. This is exciting.
You really are going to do the podcast name justice because Felix really is a brilliant trader and software engineer. And in fact, usually when I get lost in my sort of coding development grounds and I get stuck on something, Felix ultimately gets the email from me saying, "Hey, I'm trying to do this. Can you help me out? I have no idea why this isn't working." And usually he's there to the rescue. So I thank you for that. And I think this is going to be an exciting sort of conversation for everyone to kind of show off what you do and how you approach investing. So before we talk about all of the current stuff, let's go back in time a little bit. Tell us about your background. How did you get started in trading and what were you doing before investing in the markets?
Yeah, all right. So the accent you're hearing is German. So I grew up in Germany and came here about 14 years ago. My background is in engineering. So I have a degree in electrical engineering. And as an individual contributor, I mostly did actually software. So I'm basically writing software since I was 16 years old. Or actually, I had my first job in writing software when I was 16 years old. And I never really stopped tinkering around with software. As a manager later on in my career, I actually did a lot of consumer electronics in the professional music space. And most of my career was actually in professional music production. And this whole background, that actually helps a lot in looking at trading. So when you look at stock market data, for example, they're actually very similar to audio data. And it really helps to have a little bit of an audio background and know what digital signal processing does when you're trying to filter out noise and extract the signals that you're actually looking for. So the engineering background really has helped me a lot in coding the stuff and in understanding what I'm actually doing there. And I got into trading fairly late. So for a long time, I trusted in other people to help me with investing. And in 2009, after the recession, it was really clear that this wasn't working. And for once, the professionals I was working with weren't really up to the task or up to my expectations. And also when I started looking into available products, then basically I found that the available investment products are surprisingly boring and they're kind of behaving all more or less the same. And if you want something that is fundamentally different, that behaves fundamentally different from your typical 60-40, has a lower beta and a higher alpha, then there's nothing out there that you can just buy or where you can just go. And that's how I got into this and started doing my own stuff.
Now, you were sort of kind of scratching your own itch, so to speak, when you kind of came into this. But when you say that there wasn't anything that you saw that was either uniquely different, or you were sort of upset or kind of tired of the offerings you had available, that assumes, I mean, you had to have had a good understanding of the landscape. So were you frustrated with sort of the returns your portfolio was getting at the time, or the volatility your portfolio was experiencing? Like, what clicked that said something had to change and I had to take this into my own hands?
Well, when you trust your typical average broker-dealer representative, they are going to recommend you some investments in some funds. And when you look at what your portfolio actually did at the end of the year, most often what you find is that you underperform the market at higher volatility. And, well, this can't be it. So I guess we all want something better and we all deserve something better. And luckily, I honestly firmly believe that we can do better.
So you've got a strong engineering background, you recognize the problem, and so you take it upon yourself to sort of solve this investment, optimization problem yourself. Where do you start? What's the next step when you decide that something has to change?
So the really first thing that I started doing was just downloading some stock quotes and playing around with that. And I started in Excel, and then the stuff grows, and it grows in unexpected ways, basically like the weeds in your yard. And it becomes more and more work, and you realize, oh, well, this is not maintainable. I need to do something else. So I started coding something. So I basically coded without even knowing what I was getting myself into. I started coding my first own backtesting engine, and that was written in Perl. I don't know, honestly, in hindsight, I have no idea why I started writing this in Perl. I guess it's the worst language that you could choose for this. But I did, and I've came surprisingly far with it. And I started developing a breakout strategy that was working surprisingly well for a while between 2011 and 2014. Honestly, it was beyond belief. And but it was also fairly risky. And I learned that the hard way when basically on one day I just wiped out about 2 years worth of earnings. And that kind of triggered the next phase where I realized, okay, well, I need to think more about risk, and I need to get better tools and see where I can go from there.
So I don't want to you gloss over this point very nonchalantly, but you created or you wrote your own backtesting engine. Now, I have a degree in computer science, and that to me sounds like a tremendous project. I get tired when my backtesting software doesn't have an indicator that I want to use, and I have to program, some small snippet of code. So the undertaking there is pretty tremendous. But I guess before we even go down that rabbit hole, I would be curious. There were other backtesting engines on the market at this time. So what inspired you to sort of start from scratch on creating your own?
Well, the first thing to see there is that I actually had all the time I could possibly want on my hands. So at that point in time, I was traveling a lot for business. So I spent about something on the order of 15 to 20 weeks a year in China. And when you're out on the countryside where the factories are in China, there's not much to do at night. And so at some point you realize you can't get drunk at the bar every night, and you have to do something else. So that's basically the time that I used for coding. So I sat there in my hotel room with a bag of chips and a can of beer and was coding. And that, I guess, honestly, was something to keep me sane. And it has something tremendously therapeutic to code a strategy and then see an equity curve, and you have all these ideas in your mind. Oh my God, if this is real, why am I here? Why do I need to work at all? And so that is very motivating.
I mean, to start from the ground up and to engineer everything yourself and to know how it all works and to have a laboratory essentially to continue to develop these systems, greatly satisfying, I am sure. So let's go back to the comment you mentioned earlier about kind of the breakout strategies is where you started. They were working well. You had the blow up, let's call it. What was next in terms of the trading approach? Where did you go after you experienced that sort of setback on the breakout system?
Well, I guess what was missing for the most part was better tools to ultimately analyze the performance of my trades. And just having an equity curve is really not a whole lot. So you want some metrics, and you want your underwater charts, and you just want to get a little better with that. And also, I started realizing that the data source that I was using free data that I downloaded from Yahoo, that this was not a good data source for what I wanted to do. So I really need to step up the game. So this is when I bought my first multi-charts license. And multi-charts was actually the tool that at least had a lot of the features that I was looking for. So it had reasonably nice reports. It is reasonably good in handling portfolio strategies, which other tools like NinjaTrader don't do that well. And it had data sources built in, and I could subscribe to a service and get better data. So so that helped me a lot in making the next step there, basically.
What was the strategies, or what were the types of ideas you were working on at this point? Were they still momentum and kind of breakout based, or did you transition a little bit?
I transitioned actually, and I started looking into pure momentum strategies. And well, all of them being portfolio strategies where basically I try to rotate assets, mostly individual stocks. And I started spending a lot of time on figuring out how to improve risk management, and how actually risk management ties into your ranking of assets to trade.
So the next sort of fundamental piece, so you're tying in now the risk management, survival in the game. You're advancing sort of the understanding of the systems that you're looking to use. Where are you still with multi-charts at this point, or have you now kind of migrated off to something else?
Being a software developer, you see, when there's something that the tool doesn't do for me, um, I can just write these missing pieces. But what happened here was that I was bolting on more and more stuff on top of multi-charts, that at some point I've noticed I'm not using any of the multi-charts features except for the data sources anymore. I'm using my own reporting engine. I was experimenting with options at that point in time. It wrote basically a simulator engine that sits on top of multi-chart, so I wasn't even using the simulator. All I was doing, I was bringing in the data via their framework. And at that point, I decided, okay, now is really the time to ditch this all and start a new project for a new backtesting engine. And this is what became the TuringTrader.org project. So it was really something that, again, on a sunny afternoon, I decided, okay, now I'm going to do this. And this was probably sometime in, well, it was actually summer. I guess it was sometime in July 2018 or so that I decided this is what I wanted to do. And it pretty much coincided with the time where I became a full-time trader. So I had no other side gigs anymore and did this full-time. And it took me something on the order of 3 months to get the simulator engine to the point where all of the portfolios that I had and that I was actively trading were now running on the new platform.
So now TuringTrader, we're going to get into exactly what that is in just a moment, but was this the transitioning the old sort of Perl code that you were, the old chips and beer construction from years earlier? Was this the transition of that application, or did you sort of start fresh with TuringTrader?
I did start completely fresh, and the reason for that is really, well, Perl is not a very well-structured language, and one of the things, if you're familiar with Perl, that you will find that it's much easier to write Perl than to read the code, even if you've written it yourself 6 months later. So honestly, a lot of Perl code is write-only. Never ever try to read it and understand it later on. And so none of that code survived, not a single line. But a lot of the ideas that I had then did, and a lot of the stuff that I used to expand multi-charts that actually made it into TuringTrader. So there is a lot of code in TuringTrader that is much older than the TuringTrader project that I basically carried over from my multi-charts times.
So TuringTrader is a open source backtesting engine that all of us can use. Traders can go on right now and download this entirely free and start playing around. What else? That's the high level view, but how else would you describe it? And just talk to me a little bit about the project and kind of where it sits now, maybe why someone would even want to download it or use it.
Well, I guess TuringTrader is very different from other simulators, and it will continue to do so, I think. Projects like this, of course, are never finished, so it might change direction, and I have some ideas where it might change direction to. Yes, you can go and download it and for free, and you get all the source code if you want to. And it is a professional level simulator. There's a lot of things that you can do with it that are much harder to do on any other simulator engine. So there's a few points that I'd like to mention here. So for once, TuringTrader can simulate option strategies. So there's actually not that many simulators out there that can do that. Another thing that is unique about it is the way how it handles data. So there's a one-to-many relationship between what TuringTrader calls a data source and an instrument. So one data source can actually launch many, many instruments that you can trade. So basically like one ticker spawns many, many options contracts that you can trade. And there's features on the data side that I feel are very important. For example, there's a feature there where you can splice data. So when you want to run backtests, what you often find is that the instruments that you want to trade didn't exist far enough back to actually create a test that is meaningful, or it spans enough time to be really meaningful. And in TuringTrader, it's very, very easy to extend those data back to an earlier time if you have a reasonable proxy that you can use.
It's a great application for, and you can sort of tell it's been built by a trader first. So I've been using it for a number of years now. For those familiar with the strategies that we run, our latest system, Lamerick, was built entirely in TuringTrader. And so some of the functionality that Felix describes there of getting data back, an extended period of time via splicing, via mutual funds, or whatever it is just really nice and elegant. It solves a lot of the limitations of some of the other backtesting engines out there right now. So this has been an ongoing development for you. I see, you continually make updates to the repository over time. But this becomes your central sort of laboratory to develop trading systems. If we go back to the path that you were on in terms of the investment strategies, what did TuringTrader now allow you to sort of create, and where did the trading side of your sort of journey go after you kind of released TuringTrader in its more modern form?
Well, there's a few influences a few books that I read that have truly influenced my style of trading and what I like to do. So one of my favorite books is Andreas Klenoff's Stocks on the Move. And it is actually a book that talks about an aggressive momentum trading strategy that trades individual stocks. And there's a lot of description of the reasoning behind, and the strategy actually, for the most part, works. There's some omissions in the book where I feel that either it was left out intentionally, or I'm not really sure what happened there. So there's some flaws in the risk management of that strategy, but there's enough reasoning in the book to help you understand what this is all about and to find these flaws. It's really not that hard. And once you sort out these flaws, the strategy actually performs surprisingly well. And I continue playing around with it, actually. So the core is actually fairly good. And this is really just a momentum. The main thing that's different about it is that it's using a concept of risk-adjusted momentum to rank the stocks that it's actually trading. And it's using equal volatility position sizing. And what's important to understand here, and the book actually does a decent job in explaining that these two go hand in hand. This is not the ranking and the position sizing have to go hand in hand because they depend on each other. There's no point in picking the stock with the highest momentum if later on in the position sizing and you decide, I can only invest a few pennies on the dollar in that because it's so volatile. So you basically have to think about the efficiency of every dollar that you have in capital, and that is what this ranking does. So this is something where I learned a lot from. And another book that I really liked is The Alpha Formula. And Chris Kane and Larry Connors here describe basically how a portfolio of strategies reduces the overall volatility and improves risk-adjusted returns. And this is a concept that I'm really bought into. This is something that I like to do with the strategies that we have on TuringTrader.com. We call them All-Stars portfolios, but hey, that's just a name. And this is actually something that is surprisingly hard to do with other backtesting engines. And one of the things that is actually interesting about the TuringTrader backtester is that you can use a strategy as an input to another strategy. So basically, you can stack them on top of each other and build more and more wild constructs where one strategy serves as the data source for the next, so that you can build pretty complex hierarchies of strategies. And so implementing the alpha formula with TuringTrader is actually easy, while it is probably hard work with any other engine. And then there's Scott Judd's and the 7 Phases of Risk. This is a book that really, really speaks to me because Scott Judd's is actually an engineer, and he approaches trading completely from the signal processing angle. So everything he talks about is about signal processing and improving signal to noise ratio. And that is actually all stuff that speaks to me as an engineer, and especially as an engineer with an audio and signal processing background. And while the book is not necessarily suitable to get you to code and reproduce his results, there's a lot there to learn. And I've been actually able to, for the most part, I guess, reproduce his strategy, and it's performing very, very nicely. And it's another core that I will be continuing to use moving forward. So great read. I can recommend it. Language lacks a little bit, but the content actually is really good. And then there's Wouter Keller, who's a university professor and publishes a bunch of papers. All of these papers are fairly well written. And what's interesting here is really that every single paper focuses on a unique idea that you will not find anywhere else. So he's trying to introduce a canary universe to detect market crashes, and he's trying to use macroeconomic data to guide his trading decisions. And a lot of these bits and pieces I have used in strategies that I'm developing on my own. There's not a single strategy that I want to point out that is performing particularly well, but when you read these papers, you learn a lot about different ideas and where they might take you, and it kind of inspires experimentation.
So those are 3 books. So we've got a handful of resources there. We'll put the links in the show notes to this episode so you can check out those books. So those are some great, inspiration starting points. I want to go back to one thing you said there. So this concept, I think it's from the Alpha formula book, which is the concept of a multi-portfolio, a multi-strategy portfolio. Most traders, I think, have one trading system or one strategy, and I know this is what I did for years. I tried to put all the bells and whistles and the filters and everything so it could handle just everything that we could throw at it. I since have sort of scraped that and opted for more simple systems that are doing different things and combining the different systems together to one portfolio. What are some of the benefits there, or like what are people kind of missing or could just think about that are going down the path of just having one trading system to do everything?
Well, what we all expect is that our backtests are predictive of the future. And what we all hope when we design a strategy is that these mechanisms that we develop are able to handle future situations gracefully. And now, of course, we can go down the path and making our systems more and more complex in trying to deal with all these various situations. But as you can see, just by looking at 2020, there is surprises, and we might run into situations that we haven't seen before that ultimately lead to disappointing underperformance. And just in 2020, for example, when you look at most of the classic momentum strategies, they all got it right to exit sometime between March and April. So pretty much all of them got that right. But what happens then is that most of them failed to get back into the market, and they missed the rebound and ended up way below the benchmark. And this is something, for example, we haven't seen a rebound that fast in the last decades. And to assume that our strategies that we code up are actually able to deal with all these situations, well, maybe that's a little bit naive. And when we're switching to a meta strategy, we can hope that we do better, because at least we might have a fighting chance that not all of these systems fail at the same time. And that in itself might lead to a better result. And also, when you look at it from the coding perspective, once you get a ton of indicators and different mechanisms in there, the code actually gets hard to maintain. It gets hard to understand. And you might have some unexpected edge cases that are really hard to fix. And so basically what I'm doing now is I'm trying to focus on one idea that I have, and I try to code that up as simple as I can. And often then I combine multiple ideas to a larger thing. So if you, one of the recent things, for example, that I developed was a market sentiment indicator. And that uses 5 different sources of information, but I developed each of these 5 sources of information individually and try to make it as good as I could based on that single idea, and then combine them in a voting mechanism. And the idea really is focus on one concept and not try to mix all that. And for me, at least, this has simplified development. This has dramatically increased my productivity. And honestly, the results look much better.
Right. So it's kind of a win-win on multiple levels. It's simpler code. You can understand really what it's doing. You eliminate those edge cases, and it's something where you're not striving to create one thing, one bloated system that is going to try and crush the stock market. You are opting for a simpler approach and combining these, stacking them together like Lego blocks. You're combining those multiple systems. And like you say, and like you point out, that's a very important point in terms of March, is lots of systems got out March of 2020, coronavirus height epidemic, where the market melts down, lots of systems get out, but how many of them got back in, right? That's the big question. And having a diversified pool of approaches to the market is one way to sort of solve that. So I really like that concept. you've got a lot of different portfolios now on TuringTrader.com. So talk to me a little bit about kind of the strategies. You mentioned a few of them already, but what kinds of strategies, what are the different characteristics? How many do you need, of these simple models to put together, in your view?
Honestly, to have a good and successful trading strategy, you might be doing fine with just combining 2 or 3 ideas with each other. So what I'm trying to do is that I'm trying to combine strategies with each other that have a different mechanism that makes them work, even though maybe the ultimate underlying idea is similar. You see, most of the strategies are ultimately momentum-based one way or another, maybe. But even if you look at momentum, there's different ways to look at this. You can try to rank them by extracting momentum. You can try to find combinations by doing mean variance optimization. And when you now have these 2 different ideas, they will lead in different ways of entering and exiting. And combining these 2 will most likely create much better results than each single piece would. And if you now have something like mean reversion that you can add to the mix, that's probably great. And something that I played around with and that worked really, really well in 2020 was hedging with volatility. So either volatility targeting or even going long volatility at some point. And when you combine these multiple mechanisms, it really doesn't need more than 3. Then the results are generally much more docile in behavior, and I have much more confidence that these results will hold in the future.
So let me be a little bit of a critic here on the process of backtesting or investing or trading in sort of the fashion that you're pursuing today. If I were a critic here, I would say that, well, the exercise of sort of backtesting in general is an exercise in data mining or curve fitting, and we sort of just wrangle the data to eventually just get what we want to see in a backtest, right? So what is that true? What is your sort of response to that type of critique or the doubt? The people that are perhaps doubting a fully sort of systematic or quantitative approach.
Well, I guess we're all guilty of that approach, including you. But I firmly believe that the markets are not as efficient as people like them to be. So the theory that markets are completely efficient seems to be just seriously flawed, because there's so many things where you can run some analysis and see that over decades, markets are not efficient. You can see, for example, that in times of high volatility, the average returns are significantly lower. That's a clear inefficiency there. And you can prove that. And you can also show that there is a serial correlation between yesterday's returns and tomorrow's returns. So there is an inefficiency there that proves that there's long periods of time where momentum is real. We can also show that there's mean reversion effects that are very real, that prove that the markets are not efficient. And all that we're trying to do is we're trying to exploit these little edges. Now, of course, that is data mining, and of course, there is the risk that we're overfitting our models. And what I'm trying to do, we're trying to get better at, I'm using the optimizer less and less nowadays. I'm trying to use less and less parameters for the strategies. What I do, though, is that I work more with walk-forward optimizations, where I'm basically looking at short look-back windows and trying to continually adjust my parameters and have my strategies figure out the best parameters themselves on the fly and while they go. And at least so far, I'm fairly happy with the results, and this seems to work fairly well. Will this hold for the future and forever? I don't know. I guess we need adapt our strategies. And no strategy that we are able to develop today has the expectation and the promise that it will last forever and will be good forever. So at some point, I guess we will need to revisit what we're going to do with bonds, for example. How much longer can we use treasuries to hedge? And when rates ultimately start rising and treasuries have a negative carry over longer terms, what else can we use? Are we then using a mean reversion component? Are we then using more volatility to trade? We will find out. We will continue developing. And honestly, I do this full time, and every day I'm trying new ideas and working on that. And you can see that on my site that we're releasing new strategies and retiring older ones, or if we're not retiring them, well, focusing on newer ones and making progress there. And I guess you need to continuously sharpen your tools and see what you can do.
Yeah, that makes total sense. I mean, I think the big ones, like you say, to sort of reduce the potential for that overfit, less parameters in the trading system, simpler systems like you're going down walk forward and Monte Carlo simulations, right? These are all the techniques, I think, that you sort of alluded to there to remedy that. But obviously no approach to investing is perfect, right? We're not, I don't think anyone here is trying to claim that this is the only way to sort of trade or you have to approach the market this way. But I sort of want to kind of blend in here because we have a lot of listeners that I think they're technical traders for sure. Lots of traders trading off of either chart patterns, technical indicators, kind of the pseudoscience of, not fully backtesting like you are, not creating, a backtesting simulator from scratch. But they're aware of the data. They're aware of momentum and when to get in and when to get out. What is the last sort of leap there, though? I mean, the slight discretion, and we all invest with discretion, but to the trader that perhaps is trading off of charts, doing this again in their head, but maybe is interested in what you're doing, how do they take that final leap, or what is the bridge there to go to a fully kind of dark side quantitative approach?
I'm afraid that many traders ultimately don't really know how well they're performing. I've met way too few traders that actually go through the effort and trying to figure out what their equity curve cleaned of withdrawals and deposits really looks like. And because that's a lot of work to do that. And we all have the tendency of staring at a screen and seeing the market go in a certain direction. And then we have the urge to say, oh, I want to take that swing. And but I firmly believe that it is just a bad move to do unless you can prove yourself that your senses are actually good. And so you need to prove yourself that your rules are actually good. And the problem there is when you do this live while trading your own account, well, it will take you decades to figure out whether your senses are actually good enough to make the right decisions. And if they aren't, this is going to be very, very painful and very expensive for you. And what the quantitative side does for you is that at least it shows you within minutes you can have the experience that other people need to make in 50 years of trading. Within minutes you can see, okay, if I did this, then that happened. And I can figure out, does this make sense or not? And one other thing that honestly I've learned to appreciate is to have strategies with rules that I can understand, where I can say, yeah, at least in my worldview, this is the right thing to do, and here's why. Instead of just chasing some random, how should I put it, some random correlations, because ultimately correlation is not causation, and it might be that something else might be the better target to chase. And Well, and to get into that, well, ultimately, I guess you need to learn to code, and learning to code is fun, and it is actually a great skill to have, because there's so many problems that you can look at this way. And it doesn't need to be super hard. You can start small and see where it takes you. And if you look at the TuringTrader open source project, then that project comes with a source code for a bunch of strategies that I've taken from books and publications. And what's great about that is you can have the book or the publication in one hand and the source code on your screen, and you can compare and see, hey, how did he do this? I see this rule here. Where do I find that in the code? And reading somebody else's code and figuring out how the code corresponds to the rules, that honestly, I think is a great way to learn. And for anybody interested in learning to code and learning to code these types of strategies, I recommend looking at our showcase strategies and seeing if they can get started that way.
Yeah, it's a great point, and it's something I don't think I've actually fully appreciated the way you sort of stated that. But basically, being able to put your strategy into code gives you 50 years of insights. In other words, if you're a technical trader that likes trading, moving average crossovers, you could simply put that into code and basically, very quickly kind of see how that strategy performed years and years and years. And just gives you that, gives you either the confidence or maybe the intuition that you may need to move on to a different system. The other thing that Felix pointed out there, just to reiterate, is that in TuringTrader.org, if you download the repository, he has a bunch of pre-built trading systems there, or tactical asset allocation models with the source code available. So you can basically, run the back test. You can see the rules to the system. Most of them are public. And then you can also see the code. So it is a great way to sort of get your feet wet and see how all of this works from a coding perspective. It's sort of, one of the things that, as you were talking, you touched on, which is interesting to me always, is do you need to know the return driver for the system, right? So you as a quant systems trader, in other words, if I say, Felix, trade the RSI with a 10-day look back, as soon as it goes over 80 and the MACD is in this position, and it produces this, beautiful equity curve, you use Monte Carlos, you try and break it, you go through all of your tests, and it holds up. I mean, is that enough for you? Or do you need to understand the actual driver of this trading system that you're deploying?
I clearly don't trade a strategy where I don't personally buy into the concept of it. I believe that mean reversion is real. I believe that momentum is real. So maybe I'm not that hard to convince. But if people show me a strategy that has a weird mechanism there that I cannot grasp, where I do not believe that this is a good idea to do, then I won't trade it. For example, there's some surprising strategies out there that use a canary universe to figure out whether to stay in or out of the market. And I'm not fully sold on the idea, just as an example here, that the performance of emerging markets is a good indicator for the US stock market. And because I do not buy into that idea, I don't care how great the backtest might look like. I would not trade it. But ultimately, trading is a matter of conviction. And if you want to run the strategy without second guessing it every day, you better believe in the mechanics of it. And it is hard. It requires discipline to put in a trade when you feel like the market is going down. Why am I buying this? And in order to stay on track and stay within the bounds of what your backtest showed you has worked in the past, well, you need to believe in it. If you don't, I don't know where you take the strength from to actually do something that you don't believe in and don't understand.
What is it that you need to see in a new model to actually consider putting it live? So you're doing your research, you stumble upon something that looks pretty promising. I mean, is it, it needs to generate 15% returns per year? Like, is there a certain threshold? Is it a Sharpe ratio? Is there anything that specifically there's a few high-level boxes it needs to check?
There absolutely are. So one thing that I really like is Monte Carlo simulations. So I really like to see what the probability of reaching certain returns and certain maximum drawdowns are, and how this curve looks like. The TuringTrader project has some unique way of showing these Monte Carlo simulations, where you basically have a bell-shaped object that you can see that, and the more slanted this bell is, the more uncertain you are of the returns or the drawdowns. So you want to see that the risk profile is fairly flat and the return profile is fairly tall, and they're both mostly parallel. So this is certainly something that I look at. Another thing that I always look at is I always want to see how the strategy performs in relation to a benchmark. I never look at performance in isolation. I always want to see it charted against the benchmark. And one of the things that I especially like is to show rolling returns versus a benchmark, and to show the tracking error, basically dividing one equity curve by the other and see where this goes. And what we want to see is that we're making continuously progress versus the benchmark. It doesn't matter that my strategy yields 20%. I want to see that year over year, it's actually beating the benchmark that I've chosen. And so this is very important to me. Other people might feel differently. I'm not necessarily a big fan of the Sharpe ratio. I prefer the Martin ratio over that.
As we sort of wind down here now, Felix, I'd be curious to know, what does successful trading look like to you? So if I asked you, what does it mean to be a successful trader? What is you doing your job successfully present day? What does that mean to you?
That is a big question, and honestly, I don't know what a simple answer to that is. You see, I'm seeing the markets from multiple angles. I'm seeing it with my own money. So I invest in my own strategies. So I really put my money where my mouth is. And ultimately, we all want to make money, but it is not about the maximum amount. It really depends on what your objective is, where you want to go. And as long as I beat my benchmark, I feel that I made progress. But this benchmark doesn't necessarily need to be the S&P 500. And also most people use the S&P 500, not the total return index, which is already off by 2% anyways. I feel that ultimately, you see, we're jumping through all these hoops of trading and sitting in front of the computer every single day. And so the question is, did we improve anything by doing that? And so I guess the benchmark would be a passive portfolio that has a risk level that you're willing to tolerate. And that might be a 60-40, that might be something else, but something that you, from the risk perspective, feel comfortable with. And well, if you can beat that without adding risk, then probably you've been successful. But that is not a percentage number. That is something that you can only judge in a relationship to a benchmark. And well, then the other angle that I see is that that I also have clients that are investing with me. And well, these people might get nervous occasionally and give you a call and say, Felix, this doesn't look good. And other times, honestly, I'm getting emails like, oh, the algorithm really nailed it. And well, so the perception of what success is might be very different. And ultimately, I guess it's important to zoom out a little bit and don't measure your success on a daily basis, because there are days where you're down, and where you're down even more than your benchmark or even more than the S&P, and that doesn't feel good. And it's important to say, like, well, look, on average over the past 6 months, this was working fairly nicely, and well, I can't expect that every day I'm beating the market, and we shouldn't get a heart attack today because we actually made this money before. And so this is very different when you look at your account every single day, or you're looking at your clients' accounts every single day, versus them maybe looking at it once a month. That feels very different.
Yeah, for sure. It's balancing that short-term, anxiety and with the long-term sort of balance. And yeah, it's a curse. It's a great thing and a curse, I think, for us that are staring at our accounts every day, that are either watching the systems unfold or placing the trades. You get scored every day, and you can spot opportunities. You can understand the context behind it better, but you have to live with the emotional baggage sometimes when things are tough. So. Is there anything we may have skipped on today? Is there anything we didn't talk about? Anything you want to kind of circle back on now and just either recap or touch on that we may have missed in this conversation?
One thing that maybe we can mention real quick is, well, the TuringTrader.org project is an open source project, so it is really free to use for anybody out there. I'm not holding back on any secret sauce that I use for myself or whatever. For anybody interested in this stuff, I encourage you to have a look at it. And the reason why I open sourced this is really because I firmly believe in open source. I have benefited from so many people that have written publications, that have shared code online and in other ways with me, that I feel it is an obligation at some point to give back, and I happily do so. And being somebody who has spent most of his career in selling intellectual property one way or another, you will find that I don't steal software. You don't find pirated copies of software or data or whatever on my computer, and that I really believe in sharing that. And I believe that there's ways to create good businesses, even though you're sharing part of your underlying technology.
I love the message there. And for all you developers that are savvy in .NET, C#, then you can contribute to this platform and make it even better. Like Felix said, completely open source, and you can start using it to build systems and to start just researching the market today. So that's it, folks. All the show notes and links from this episode can be found on the blog at thetraderisk.com/podcast. Thanks for tuning in, and we'll see you in the next episode. Felix, thanks so much for joining me today.
Evan, thank you so much for having me. That was fun.
Thank you for listening to Smarter Trading. I hope you enjoyed this week's episode. For all of the show notes, links, and callouts, head on over to thetraderisk.com/podcast. If you enjoyed this episode, please leave us a rating and review on iTunes. Smarter Trading is hosted by me, Evan Medeiros, and produced by Ashton Alexander. Thanks for tuning in, and we hope to see you in the next episode.